Hello, everyone. We are so glad to have you all, viewers at home, and of course, our panelists. So, as Luke says, this session is titled Profit Shifting and Tax Avoidance, the Impact of Multinationals Tax Practices on Labor and Equality. And just to give you a little bit on the session framing, the problem of corporate tax abuse is regularly acknowledged in global policy forum, with debates on how best to address the issue continuing. In this session, we will examine why current tax practices of multinational enterprises are so damaging to employee wages and domestic tax revenue, and how this contributes to increasing inequality and the erosion of the economic and social rights of citizens. The session explores new research and evidence relating to multinational profit shifting, looking at its impact on wage and capital gains and the consequences for inequality, as well as exploring implications of current policies and regulations intended to target these damaging practices. Further, we will draw on the Tax Justice Network Corporate Tax Haven Index. Rachel will tell us a little bit more about that, to analyze the scale of the problem and consider solutions to tackle corporate tax abuse before opening to an audience Q&A. So again, so happy to have you all. I was just reading these papers to prepare for the session. I was telling myself I'm so incredibly lucky that my job is to read these papers. So anyway, we will also please remember, and I'm talking to the audience here, to use the live discussion button in the bottom right of your screen if you would like to have any questions for the speakers, and we will turn to the Q&A in the later half of the session. So that's pretty much from me. Now I'm going to hand it over to our first speaker, to Rachel Eder-Poya. Rachel is, of course, a senior researcher from the Tax Justice Network, and she will be presenting as the Tax Justice Network's Corporate Tax Haven Index, which is about the scale of profit shifting and tax abuse for context setting. So the floor is yours, Rachel. Thank you so much.
Thank you, Fernando. Hello, everyone. So as I was preparing for today, the centrality of taxes to revenue and redistribution to achieve the spectrum of human rights has been brought home to me really by the gross inequality of COVID vaccines. So I was raised and I still live in Malawi, and it's home for me. So a week ago, vaccines ran out. And at that point, only just over 43,000 people had been vaccinated with the 2 recommended doses of the vaccine. So that's, just think about it, 43,000 people. That's probably less than the people that are living in the town or city where you're currently calling in from today. And it's less than 1/3 of 1% of the entire population of Malawi. So of course, tax justice is just a part of this complex COVID story, but human rights cannot be met without revenue, and addressing inequality requires redistribution. Yet multinational companies are underpaying their taxes in many places thanks to domestic tax systems and international tax architecture. Profit shifting is punching holes in the public purse, and inequality worsens, which undermines the full spectrum of human rights: civil, political, economic, social, and cultural. But which countries are most complicit in enabling corporate tax abuse? So motivated by this question and concerned that existing so-called blacklists of tax havens are biased and they target states that don't really matter in practice and turn a blind eye to the richer, more geopolitically powerful nations, we got to work. So through the Corporate Tax Haven Index, we set out to map which countries enable global corporate tax abuse the most. The Tax Justice Network's research is a guide on how specifically countries can put an end to corporate tax abuse. And it also sets to dispel these myths of tax havens as tropical islands and disturb the mirage of and perceptions of low corruption in Western Europe and North America, just as Atia Waris was discussing with Stephen Dean yesterday and Alex Cobham on tax havens. And I hope you tuned into that, or you can rewatch that session as it was fantastic. So without getting too deep into the weeds, let me explain how we can examine the role countries play in the global problem. The Corporate Tax Haven Index, we assess the domestic corporate income tax rules for multinational companies. And based on this, every country receives a haven score. But we don't just take the haven score at face value. A country with a high haven score or laws that enable multinational corporate tax abuse is a problem, but it's only a problem to the extent that the country is actually used by multinationals for profit shifting. So to really understand the contribution of each country to global corporate tax avoidance risks, we also measure the relevance of each country for cross-border investment. So through assessing 70 countries in the Corporate Tax Haven Index, we capture 80% of all foreign direct investment. And I'm just going to share a slide now. So great. So the second edition of the index that we published this year reveals again the UK's and its spider's web of overseas territories and crown dependencies, exposes their responsibility for corporate tax avoidance risks. And it also reveals the colonial roots of many exploitative double tax treaties. In fact, 2/3 of corporate tax abuse is enabled by members of the Organization for Economic Cooperation and Development, the OECD. And since the OECD is setting the international tax rules, this group of high-income countries has designed a system that allows multinational companies to get away with paying less taxes in the countries where they should, and this is adversely affecting revenues and rights. So to borrow from the 2015 Lima Declaration on Tax and Human Rights, countries with tax policies or practices that erode the capacity of other states to resource human rights may be in violation of their international legal duty to cooperate. And countries which purposefully obstruct tax information exchange are foreseeably depriving other states of resources needed to meet their human rights obligations. How can we hold the OECD countries to account? What domestic measures can countries take to protect themselves? So let's look briefly at the nuts and bolts of the Corporate Tax Haven Index. In front of you, you can see 20 key indicators across 5 categories. These capture the policies and practices along a spectrum of corrosiveness of corporate tax rules. First, you can't take corporate income tax rates at face value. Corporate tax havens make loads of exceptions that may reduce the tax rate or tax base of subsidiaries of large multinationals. And these reductions may make it possible for specific sectors or types of companies, or even through opaque tax rulings, to pay less than what they would otherwise. And this we have called the lowest available corporate income tax. And this lowest available income tax in one country puts at risk the higher tax rates in other countries. It perpetuates a race to the bottom in taxes and undermines the rights of citizens to determine their own domestic tax mix. So second, if you move on to the second column, we look at if there are any significant loopholes and gaps in countries' tax systems, and help multinationals to reduce the tax base or the taxes owed again. We assess preferential tax regimes for specific revenue, for example, royalties, or if there are important carve-outs for the corporate income tax base or concessions such as through tax incentives, tax holidays, and economic zones for specific products or for whole sectors as a whole. And the third and fourth categories, the third and fourth columns in front of you on transparency and anti-avoidance, can be understood as ways that countries can domestically protect themselves against multinational tax abuse. What's in place to keep companies accountable? We look at the requirements for companies to publish their annual financial statements, and on a country-by-country basis. We look at whether governments disclose mining and oil and gas contracts or publish tax rulings. We look at the requirements for taxpayers and tax advisors to report avoidance schemes or uncertain tax positions. And in this way, countries can deter corporate tax abuse and have tools to directly audit and investigate, with the ultimate aim of collecting more revenue to redistribute through improved public services. As citizens as well, we can scrutinize the actions and inaction of private actors and public servants if this information is public. Fifth, the last column, we also look at the impact of countries' double tax agreements on withholding taxes paid to partner countries. Aggressive countries push down the withholding tax rates with its treaty partners. So typically, and not surprisingly, we find that tax treaties allow neo-colonial power structures to be maintained. Rich capital exporting countries end up reducing the taxing rights of global South countries in a race to the bottom that hurts public revenues. The index contains a treasure trove of free data for research. You can access country profiles, and there's even a data explorer which allows you to access the data. And I've got the links there, and we can post them. Perhaps Fernando, you can post these in the chat for people to access or on the message board. But most importantly, the index shows what can be done to reprogram tax rules to ensure human rights obligations are met. Fundamental human, economic, and social rights can't be met as a result of tax abuse enabled in other countries. The United Nations Economic and Social Council has declared that home countries must prevent their companies from violating human rights abroad. These countries need to meet their extraterritorial human rights obligations and respect the duty to cooperate internationally to facilitate rights in other countries. And in signing up to human rights treaties, almost all countries have already committed to ensuring human rights concerns are prioritized over other areas in talks, like in trade and tax cooperation talks. Finally, before I let my fellow speakers to discuss with you more specific cases, the UN Guiding Principles on Business and Human Rights make it explicit that businesses do have human rights responsibilities. In fact, the OECD, yes, the largest contributor to global corporate tax avoidance risks, explicitly calls for companies to implement the UN's Guiding Principles on Business and Human Rights. These guiding principles don't directly address tax, yet they do lay to rest the notion that it is only national governments who face duties when it comes to human rights. Spillovers from one country to another matter. Thank you very much.
Thanks. I think Fernando's dropped off, so if you want to just pick up Baptiste, and we'll try and bring Fernando back in. Thanks.
Yes. You can see the slide, yeah? Okay, I guess so. So hello everyone, thank you for being here, and I want to thank the organizers for organizing such an excellent event and giving me the opportunity to present my work. So to introduce myself very fastly, I'm Baptiste Souillard. I'm a PhD student in Brussels. I mainly work on multinationals tax avoidance strategies. And the paper that I would like to present you today is about the effect of profit shifting on employee pay. Okay. So to present you a bit what motivated this project. So at the beginning of this project, there is a very, very large question, which is what causes the rise of income inequalities? So this is a question which is very topical and actually that has been explored a lot in the literature. So many factors have been put forward, and one of them is globalization. And we know that globalization has been combined with the digitalization of economic activities, the emergence of multinational firms, and the development of the offshore industries, all of which have facilitated profit shifting. And I think that I don't take any risk by saying that now in 2021, with the recent tax scandals, the rise in budget deficits, and even now with the pandemic that has underlined somehow the importance of public goods, profit shifting and more globally corporate tax avoidance has become a major policy concern. But the thing which is a bit funny in a way is that actually, even though the techniques used by multinational firms to shift profits towards low tax countries, in particular towards tax havens, are relatively well documented in the literature, the consequences of profit shifting are very, very poorly understood. Okay, and in particular, the effect of profit shifting on employee pay has been very little explored. Okay, so what you have to know actually for this presentation, and unfortunately I won't have time to go too much into the details, but the effect of profit shifting on employee pay has been investigated only from a theoretical point of view. So you have two strands of theories, rent-sharing theories and agency theories. And rent-sharing theories basically say that profit shifting triggers two opposite effects. Okay, so on the one hand, profit shifting reduces corporate taxes. Okay, and thus it increases the surplus to be shared between the firm and the workers. Okay, so all other things being equal, this effect would improve actually employee pay. Okay, but on the other hand, you have some papers saying that profit shifting actually gives to firm an informational rent, okay, that basically weakens the bargaining power of workers and thus decreases their wages. Okay, so you have two contradictory effects, and there are some papers, especially the one of Kotam and Schmidt, I don't know, who basically predicts that the second effect should dominate for the vast majority of employees. Right? So the effect should be negative, actually. However, we can expect actually the first effect, so the positive effect, to be dominating for very specific employees. And I'm talking about executives. Why so? Because actually executives are the ones running firms' financial operations. So they are the ones designing, managing, and implementing the business strategies. Okay, so you have these front-running theories, and then you have also agency theories saying that predicting actually that some executives should be compensated based on financial performance. Okay, so on an after-tax basis, in order to reduce some agency costs. Okay, so to wrap up, all in all, we expect actually a positive effect of profit shifting on the compensations of executives, but a negative effect on the wages of non-executive employees. Okay, so what we do in this paper to test the empirical validity of both hypotheses is that I construct a rich, disaggregated, and unique database providing information on financial statements, foreign subsidiaries, and executives of all firms that are listed on S&P Index between 1993 and 2013. Okay, so unfortunately, due to time constraint, I won't have time to go too much into the econometric approach. But basically, what I do, and with this database, that I proceed with an event study. Okay, and basically, what I do is that I look at how firm entry in tax havens influences the compensations of executives and overall payments made by firms to non-executive employees. Okay. So to show you an overview of the results, so actually I find empirical support for both assumptions, for both predictions, and actually I find that profit shifting indeed increases within firm pay inequalities. Okay, so on the one hand, I find that compensations of CEOs and CFOs that are paid on an after-tax basis increase by 8% as their firm enters tax havens. Okay, but on the other hand, in the meantime, total payments to non-executive employees decreased by around 3%. And I show in the paper that actually this decrease in total payments cannot be driven by a reduction in employment. Actually, if anything, I find that employment rises after firms enter tax havens. Also, and quite interestingly, I find that the inequality deepening effect of profit shifting on employee pay is more pronounced in firms that are intensive in intangible assets. And again, it should come as no surprise, because we know that intangible assets and the strategies management of intellectual property rights facilitate and fuel these profit shifting activities of multinational firms. Okay, so these findings are actually corroborated by many robustness checks. Due to time constraints, I don't have time to tell you more about this. But at the end of the day, I think that the findings have a very important policy implications. So first of all, they shed some light on the recent trends in income inequalities. So this is there is a well-established data fact that income inequalities have risen during the past decades, and in a way, this paper shows that profit shifting contributed to this rise in income inequalities. Relatedly, actually, the paper unveils a new channel through which globalization fosters income inequalities. And last but not least, I think that actually the paper support the recent calls for reform of the international tax system. Okay, so there is a consensus now among scholars and also policymakers that the current international taxation system is outdated and not adapted to the recent globalization. Okay, so many proposals have been put forward to tackle these issues and to better align, the taxation system and the way economic activities are conducted nowadays. But maybe surprisingly, actually, in the proposals and the discussions, actually the accent is mostly placed on tax revenues and countries' attractiveness. Okay, so against this background, in a sense, this paper shows that actually implementing such reforms could also help in curbing rising income inequalities. So thank you very much for your attention. If you have any questions, please don't hesitate. And if you want to know more about my research, don't hesitate also to contact me. Thank you.
Thank you so much, Baptiste. I'm sorry I got disconnected a little bit before and I couldn't make you a proper introduction. Of course, Baptiste is a PhD candidate in the Université Libre de Bruxelles. I'm sorry for my French as well. So next, on this session, we have Margarita Lopez Forero, a name that I can pronounce well. Margarita is a postdoctoral researcher in the Every University Paris Applied, and she will be presenting us her paper on the aggregate inequalities and M&A's tax optimization, some evidence for France. Thank you so much, Margarita. Please, the floor is yours. You're muted, Margarita. You're still muted. Let us see what we can do here.
It's okay. There
you go.
I'm sorry. Thank you very much, Fernando, for your introduction, and thank you all for being here, and also thank you for letting me present my paper on aggregate inequalities and multinationals profit shifting. So let me begin with the motivation of this paper. Am I sharing well the screen?
It's not widescreen, but I think we can manage to see the content well. Maybe you can put it. You can put it in mode lecture. There you go. Perfect.
There you go. Okay. Thank you. So let me begin with the motivation of the paper, which is the growing discontent with globalization, which is increasingly perceived as an unfair process where inequality of individuals before taxation is trampled. Thus, in the context of increasing inequalities and increasing evidence of tax avoidance of the wealthiest. However, as in this paper, I will argue that the effect of tax avoidance and inequalities goes beyond the unequal tax burden that these practices generate, because multinationals' presence in tax havens distorts the way in which we measure how income is distributed between capitalists and workers, so the labor share. So the research question of this paper is, what is the effect of multinationals' presence in tax haven, which is going to be for this paper, a proxy for tax optimization on income inequalities between workers and capitalists. So we're going to evaluate what is happening within the multinationals' labor share. Multinationals have a strong weight in the economy, so whatever happens within multinationals has aggregate effects. So what is the mechanism that we have in mind? Is that it's very simple. And here I'm showing you what is the labor share, which is just the ratio of the total wage bill to the value added. And when firms book their value added in tax havens, in order to reduce their wage bill, the tax bill, the labor share in the domestic country will be overestimated. So it will look artificially high. So here I'm just showing you a graph with the raw data where we are depicting the evolution of the average labor share by firm type. And we see that around the mid-2000s, the labor share of multinationals who are present in tax havens begins to differ from that of multinationals who are not present in tax havens. I'm not going to go through the details, but around the mid-2000s, France starts to become a high tax country with respect to its partners, despite not changing very much its corporate tax rate, which gives incentives to multinationals to shift their profits to tax havens. So in this paper, what we do is that we formally test the effect of multinationals' presence in tax havens on the firm labor share, and next we assess its aggregate effect. So what are our findings? We argue that income distribution between workers and capitalists, so the labor share, is likely to suffer from an important mismeasurement due to multinationals' profit shifting. In order to do this, we implement a difference in difference design in order to calculate the aggregate effect of micro-level profit shifting on labor share. We find that this profit shifting, micro-level profit shifting, represents at most 5% of the observed increase in the aggregate labor share in France over the period that we study, 1997 to 2014, which is a rather limited effect. However, when we go beyond the study of the effect of tax haven, multinationals' presence in tax havens on the different components of the labor share, we find that this is the result of two competing effects on the labor share. One, which is a negative effect on the numerator, so on the total wage bill of the firm, and then a positive one, which is an even stronger decline on the denominator of the labor share, its value added. And last but not least, we find that the total wage bill drop is almost completely explained by a strong decline in employment rather than a decline in average firm wages. So no change in rent sharing. A little bit different from what Baptiste finds, but as I will explain you later, this may be specific to a country, to countries such as France, where mass layoffs can be very expensive. So more specifically, we implement a difference in each of this component. So on the labor share, we find that entry in a tax haven represents an increase of 2% on the firm's labor share. However, this is the result of these two competing effects: a negative effect on the total wage bill, a decrease by 8.8%, and an even stronger decrease in the value added, a decrease by 11%. And next, when we decompose the effect on total wage bill in order to see if it is rather wages or workers that generate this decrease in total wage bill, we find that there's no statistically significant effect on wages, but rather a strong real effect with a decline of 8.6% on the number of workers. And last but not least, we implement a panel event study in order to ensure that we're capturing the tax haven entry and not differential trends between the treated and the control units. And we confirm the results that we found in the difference in difference, where the labor share increases. So here we have the distance of tax haven entry, firm tax haven entry, and here we have the change in the labor share. And we see that as soon as firms enter into a tax haven, its labor share increases. However, again, this is the result of these two competing effects, where we see a much clearer effect on the value added. So we see a sharp decline in the value added when firms enter into a tax haven. Is also a strong decline in the numerator of a total wage bill, no effect on average wages, and a strong decline in workers. So Fernando, I'm on 7 minutes, so maybe I'm just going to conclude in 30 seconds. Although we still need more research in order to make this nexus between employer accountability and presence in tax havens. This a plausible explanation for this relationship between tax haven entry and job cuts is what the trade unions claim, and it is that tax liability issues are intimately intertwined with employer responsibility issues. And this is maybe specific to a country such as France, where mass layoffs can be very expensive for big and healthy firms, and the presence in tax havens can be useful for firms in order to avoid this severance payments and all the expenses related to this mass layoffs. And I think in order to keep the schedule, I am going to stop here. Thank you very much.
Thank you so much, Margarita. I'm realizing that I'm not the best moderator because I get caught up in the presentations and I forget to control the time. Thank you so much. Now we will go with Swati Verma. Swati is an assistant professor in the Institute for Studies and in Industrial Development in New Delhi, India, and we are so glad to have her with us today. She will be presenting the paper Related Party Trade and Transfers to Tax Havens, a study of select manufacturing foreign subsidiaries in India. So the floor is yours, Swati.
I'm not able to share the screen now.
I think that I have.
Yeah, thank you.
There we go.
So it has been, my paper has been introduced. I'll be looking at the related party trade and transfers to tax havens, the study of select manufacturing foreign subsidiaries in India. This is actually a part of a project which I completed at IIT about 1.5 years ago. And roughly, as we know, at global level, MNCs have been increasingly expanding their activities, and there's been rapid rise in intra-firm transactions. There are no precise estimates actually of intra-firm trade within the TNC networks or production networks of various affiliates. But yes, some studies have established, found evidence on the prevalence of this kind of intra-firm imports, technology payments, and other kinds of transactions, especially in high-tech industries. And however, the trade within MNC networks is highly susceptible to mispricing and money laundering, profit shifting, tax evasion conduct by MNC corporations. And some studies recently have shown that 4 to 10% of global profit tax revenue is lost annually due to this profit shifting conduct by MNCs. And the risks are especially high for developing countries. The high risk transfer routes, some of these identified apart from the trade misinvoicing, service payments, intangibles, and cost sharing. So, and the central role of tax havens in this entire process of illegal transfer of wealth or tax evasion or avoidance, whatever way you put it, has been very important. And some studies have actually highlighted these issues as well. And however, when I looked at the case of India, this whole intra-firm trade of FDI invested or MNC linked firms is largely unexplored. There's no direct data, no direct estimates. Some studies have looked at intra-firm actual trade data, but these are also very much limited. Again, some evidence on profit shifting by a few studies are also there, especially by GFI report, focusing on trade misinvoicing, and by Janskin perhaps 2013. And also there has been some evidence on high level of related party transactions. But again, this is overall a very unexplored issue, especially when I look at evidence at firm level. And especially the susceptibility to tax evasion practices. If I want to know the trade with tax havens, there's no particular database or anything that I can actually even trace that. So, but again, these kind of transactions need a far sharper scrutiny, and which developing countries like India cannot afford to overlook. But yes, there are a lot of data insufficiencies, there are complications in identification and analyzing these in numerous intra-firm foreign transactions. The related party transactions are disclosed by companies in their annual reports, but there is a lot of problems in these data. The transaction heads are not uniform, non-compliance by several companies. Also, the FDI companies, lots of them are unlisted. So getting proper data for them is also difficult. They don't comply to the disclosure norms properly. And so disclosures are not actually conducive to assess intra-firm trade easily for reporting. There's absolutely no systematic record. So I tried to address this research gap. I've analyzed the foreign trade of MNC-linked foreign affiliates in India. Basically, I've looked at, taken a select set of firms, and I've looked at the share of intra-firm transactions in their total foreign transactions and share of intra-firm foreign exchange outflows directed to tax haven jurisdictions out of these intra-firm transactions. So the whole idea is that if just to assess the vulnerability of cross-border transfers to tax avoidance risk, if there is high vulnerability, the flows would be high to tax haven jurisdictions. And for each of these foreign transaction outflow channels, I have not only just looked at extent of intra-firm trade and use of corporate tax havens to these channels, but also the influence of corporate tax havens score, HS, by CTH. I've taken CTHI Corporate Tax Haven Index 2019. It basically is a risk measure for corporate tax avoidance of volume of intra-firm transactions. This has been investigated statistically. I've taken 109 foreign direct investment companies which were engaged in at least one type of related party transaction. The data has been taken from annual financial statements. Every single related party transaction has been read from these whole long sheets, and 2 recent year data I have analyzed. So overall, more than 5,000 related party transactions, and out of which 3,316 transactions were made to tax havens. Payments or outflows of resources happen to these locations. So this has been the main purpose. This lists some of the main transaction heads which I have looked at. More details are there in my paper. And for identifying the tax havens, I have taken the Corporate Tax Haven Index 2019, which basically covers 64 jurisdictions, and 2 measures for tax haven score, which is the HS score and the global scale weight. HS score I mainly focused on, which measures potential risk for a jurisdiction to become a profit-shifting destination, and it reflects risk of corporate tax avoidance on an ordinal scale of 0 to 100, where 100 would be the highest risk. Also, I have looked at the Oxfam list of worst tax havens 2016, which lists about 15 countries. And I'll quickly go through the main findings. My sample basically had large-sized firms. Some firms were very large-sized, and they were negative net foreign exchange earners on aggregate. Majority firms were listed because that was the main focus of my study. Also, 61 firms who were wholly owned subsidiaries, mainly foreign subsidiaries I've looked at. The highest number of related party transactions were for import of goods. Royalty and tech payments and interest payments were reported by fewer firms. And intra-firm trade accounted for about 2/3 of total trade. Majority of total foreign exchange earnings, 3/4 of import of goods, and 3/4 of total foreign exchange expenses, majority of total services and other expenses, and very high shares of royalty, tech fees, and interest payments. Majority again of the intra-firm trade was conducted with fellow subsidiaries, and royalty, tech fees were mainly made to parent companies. Also, since I've looked at some subsectors also, again, majority of exports and imports in 8 of 12 manufacturing subsectors were of intra-firm variety. Some shares were very high in some of the high-tech sectors. And royalty, tech fees predominantly was intra-firm paid to related parties in 10 sectors. Significant involvement of FDI companies in the GP and chain of foreign parent MNC networks as buyer of input or supplier of goods. There's some basic fact which I could trace from my data. When I looked at the tax haven association of these intra-firm transactions, major part of intra-firm payments for imports, non-imports, total foreign exchange expenses were to tax haven locations. Interest payments, services, or other payments were primarily made to tax havens, and some portion of outflows were directed towards tax havens. And if I just looked at the 15 countries to which all intra-firm transactions happened, which represented more than 90% of the total transaction under this heads, I just listed these 15 countries, and out of these, out of 15, about 10 or more were the CTHI index tax haven countries. So intra-firm trade was preferred with locations having some level of corporate tax avoidance risk. The same with intra-firm import payments, services, royalty, interest payments. I've also tested a linear relationship between volume of intra-firm transactions conducted by foreign affiliates in about 1 year of study. And I have regressed the volume of intra-firm transactions on the corporate tax havens, which is the HS score. And dependent variable is value of intra-firm transaction in 2015-16, and independent variable is the haven score, which is the ordinal scale. I've considered 2 set of regressions, one with CTHI index countries and another one with all countries with which the intra-firm transaction was happening. In this case, countries which were not part of CTHI index, I took the haven score as 0. So as quickly, I'll just share these results. For each of these transaction heads, most of the haven score coefficients were positively significant, except for in CTHI index countries, the interest payment was not significant. And the last 2 basically shows that what is expected percentage change in volume of intra-firm transaction for 1 unit rise in the haven score, which is positive among the CTHI index countries. It's also positive when I consider all countries. In this case, only royalty payment I couldn't get significant coefficients. But for the main transaction heads, which is foreign exchange expenses, import of goods and services, were positive and significant. So the results are the intra-firm foreign trade flow close by MNC affiliated manufacturing corporates in India. They are positively and significantly influenced by the risk level of corporate tax avoidance associated with destination country of trade. The three main channels of outflows: imports, services, miscellaneous payments, and all foreign exchange expenses. These were the main. These showed positive relation, and the same similar positive significant effect would be raised for not only just tax haven countries, but also when all countries were analyzed. So higher risk locations are associated with higher volume of trade linked transfers among all countries and also among tax haven countries. And overall majority of trade in exports, imports, report of foreign expenses and total foreign trade could be traced as intra-firm. Majority of intra-firm payments for imports, non-imports, total foreign expenses were tied up with various tax havens. 1/3 of these was going to the worst tax havens. Interest payments and services and other payments were primarily made to tax havens. Also, these were the main locations to which intra-firm trade outflows were directed. The top countries linked with overall IFT were identified for sample. And in the paper also I've found several instances, I've listed them, where the intra-firm import services, miscellaneous or interest payments by FDI companies are significantly tied to the network-related parties in some of the worst tax havens. And the positive and significant influence of risk level of corporate tax avoidance associated with the destination country of such trade was found for some of the main channels of outflows, which was import services and overall lot of miscellaneous payments and overall intra-firm expense transactions. So the intra-firm foreign transfers of MNC affiliated FDI companies are indeed susceptible to tax avoidance or evasion conduct. Majority of intra-firm transfers under import of goods, non-imports, and total foreign exchange expenses are linked to jurisdictions having some level of tax avoidance risk and some evidence of significantly positive effect, at least from my sample, that's what's shown. So these are my final conclusions, that the intra-firm foreign transactions of MNC affiliated companies in India need much vigilant tax scrutiny, especially with respect to the largely undetected linkages with tax haven jurisdictions, located related parties, some highly vulnerable payment modes, intangible service and financial transfers. They should attract deeper tax investigations and stringent audits, which are not so stringent currently. More comprehensive and transparent disclosure norms is needed for companies, which again is not up to mark in the Indian case. And these policy measures are crucial to check any possible drain of capital resources from the economy via tax avoidance practices, because we are a resource constrained economy and much narrower resource base would be left. These processes continue, and of course serious implications for ability of state to fulfill crucial human rights obligations, including right to development, and meet other state obligations if these processes, malpractices continue. Thank you so much.
Thank you, Swati. So
I'm sorry, I have exceeded, I think. I'm doing.
No worries. It was nice hearing all of it. So thank you so much, Swati. Now we're going to the paper of Cassandra. Thank you so much, Cassandra, for being with us. Cassandra is a PhD student in the University of Antwerp. Again, sorry for my lack of French. She will be presenting as her paper, The Popularity of the OECD Transfer Pricing Quotations in East Africa, a case study into domestic authority and contestation in governing global tax avoidance. So the floor is yours, Cassandra. Thank you so much.
Okay, I think I'm unmuted now. I will just share the full screen and I hope everything is fine. Thank you, Fernando. And I would also like to thank ICTD and the Committee on Fiscal Studies in Nairobi for their collaboration in this research project. So basically, I will focus on what countries actually can do on a national basis. So as Swati, she explained a lot about transfer pricing, transfer mispricing, related party transactions, and the profit shifting risk this entails. There is also a lot going on in terms of collective action, but often developing countries cannot wait to act upon global solutions or cannot trust that they will be in their best interests. So instead of looking at a global scale, in this project, we looked at what is happening on a national basis in different sub-Saharan African countries, because in the last decade, we saw quite some countries on the continent adopt transfer pricing regimes. And when I'm talking about transfer pricing regimes, I'm talking about the rules that restrict the ways that companies can calculate these prices. And so hopefully also the discretion to use these prices for profit shifting purposes. And that way they can hopefully also ring fence their fiscal revenue that is very much needed for development and public spending. What I also see on the transfer pricing regime is, for instance, the documentation filing requirements and the effective implementation of transfer pricing audits that could potentially end in the readjustment of the taxes due by multinationals. So looking a little bit more specifically into these countries that adopted transfer pricing regimes, we see that most of them, they base themselves upon the OECD transfer pricing guidelines. This is not surprising because it's the authoritative template soft law norm throughout the world, but it is problematic when you look at it from a legitimate perspective. As Rachel already pointed out, the OECD is not the front runner in terms of solving corporate tax abuse, profit shifting, and so on. Also looking at representation, these countries are not part of the Committee of Fiscal Affairs, and their narratives or their contexts are often not part of the discussions that take place at the reform process. Secondly, but not independently, this regime is very much cost and capacity intensive. So it is based upon the arm's length principle that still departs from the idea that it's possible to find like these comparable prices that would have been set if these two related parties would not be related. So there is a lot of what ifs and a lot of vulnerability to the facts and circumstances of the case wherein the transfer prices are calculated. And therefore that gives a multinational, because they have the facts and circumstances, a lot of discretion. And it also gives revenue authorities a kind of information disadvantage because they have to catch up, they have to verify, but this is of course a very lengthy and difficult process. And the audits itself take a long time, not only in a development context, because these audits take more than 1, 2, 3 years, but also when you look at transfer pricing audits that take place in the Netherlands, it's also not an easy fix or a quick solution that is an audit that is quickly done. So the question then is, why do these low-income African countries opt for an OECD approach? It is within their tax sovereignty to go for more simplified transfer pricing rules that maybe restrict the discretion of multinational. Also, there have been quite some authors already pointing out that this approach might not be in their best interest. So why do they opt for this? Well, in this project, we looked at 3 different East African countries that have a different timing of adoption: Kenya, Uganda, and Rwanda. And the idea is to look beyond domination. So beyond the idea, well, the OECD is powerful, has ideational power, so countries will adopt it. No, we look at the interests, the domestic political economy factors, of course, in relation with more global power dynamics that made the governments choose for this regime. Therefore, I spoke with revenue authorities, transfer pricing experts within the revenue authority, but also part of the big 4 companies, ministries of finance, and civil society organizations working on tax justice issues to see what their role and interests are in this debate. Further, I also look beyond the surface of, well, is this an OECD approach or not? But I looked into like smaller deviations within the regime. For instance, Rwanda adopted a cap on management and royalty fees of 2% of the turnover of companies, which is something that is a bit frowned upon from an OECD's perspective, but that is quite reasonable when you look at the profit shifting risk of these deductible fees, because they have a huge impact in decreasing the reported profits. Well, royalty fees, it is known that you can easily place these intangible assets or holding companies in tax havens. Well, there is a lot of playing room there. Also, Uganda and Rwanda adopted or require companies to file their country-by-country reporting within their jurisdiction, even though they're not part of the multilateral instrument, inclusive forum, and so on. So they try to learn from global initiatives, but not lock themselves in and actually ask it on a unilateral basis. So, well, don't get lost in this, in this image, please. So basically on the question, why do they choose for an OECD approach? It's quite a familiar story. It's about tax competition, tax arbitrage, and the scramble for foreign direct investments within these countries. So to give a very concrete example, in Rwanda, which has adopted quite, well, relatively strict transfer pricing regulations recently, after this was approved by the Ministry of Finance, it was halted at the presidential office because there were concerns that the strict documentation requirements would decrease the investor attractiveness of Rwanda. And there are multiple examples like this. So this is kind of a weighing of interest for governments. Then when you look at the advisory role of the Big Four, for instance, they also support an OECD approach because it's like the lowest common denominator. It doesn't change the rules of the game. It remains within the global, well, consensus as it is at the moment. When we look at the role of CSOs, they did raise the urgency to act upon profit shifting, but did not really point to a specific policy intervention. So it could just as well be the OECD approach. At the same time, when we look at the revenue authorities, a very important stakeholder in terms of transfer pricing governance, they do document success stories while adopting transfer pricing governance from an OECD perspective. So it's not, I can give some numbers from Kenya if anyone's interested in that later on. So at the same time, we also saw some deviations, such as the example that I gave for Rwanda on the caps on royalty payments and management fees. So interestingly here, we see again the role of the revenue authorities, but because these on a regular basis write reports to the ministries of finance stating which kind of transactions are most difficult to audit, what kind of transactions do they find that they are being used for profit shifting? What are the difficulties in access to information? So they're very concrete everyday recommendations that sometimes do end up in simplifications of the OECD regime. But at the same time, different examples were there where these recommendations were left at the Ministry of Finance, but then only got through when they received some endorsement, for instance, by the African Tax Administrative Forum, by the IMF, and so on. So in general, it's quite a plea to look at the expertise that is present within the revenue authorities, open up possibilities also of different advisory services, technical assistance, and so on. And I will leave it at that because I'm out of time.
Thank you so much, Cassandra. Thanks again to everyone. We're running a little bit late, so I'm gonna wrap up my comments as short as I can. I have a bunch of them actually, so maybe we can have closed doors workshop after. Maybe putting a bit together my comments. So I found so fascinating reading Baptiste and Margarita's papers, because I think both of them touches on the connection between labor and taxation. And I think that's relevant because of two issues. First of all, because I think the tax justice movement has struggled for a bit trying to find a popular base to support its claims. You know, like how to turn tax justice issues into unions issue, for example. And we have been struggling with that for a while, and I think these papers gives us a lot of place to discuss these issues and actually take the unions into the tax justice framework. And I'm also interested in and this is maybe a question for later for both of you, in thinking how maybe there's, I don't know if in France this is the case, but there are a bunch of places in which the workers have rights over the profits of companies. A percentage of the profits is in the hands of the workers. In Peru, it's from 5 to 10%, for example. So this might open some space for labor law actually to use its own instruments to fight against profit shifting and corporate tax abuse in general. So I would also very much like to hear your thoughts on that. Putting together a little bit of what Swati said and also the explanation of Rachel about corporate tax havens, I was thinking about how there is of course the issue of the quantity, the amount of transactions, which is a major shift in how the corporate tax haven index is approaching to the issue of tax avoidance in general. Let's not focus on these little countries, but let's take a look at the huge amounts of financial transactions and financial flows. And that also comes with Margarita's approach, with Swati's approach to see actually where does these transactions come from and in which quantities. And from all of this, what I wanted to hear from you is how do you think we can use this corporate tax haven for tax authorities? And Swati mentioned a little bit about how tax authorities could look at these corporate tax haven indexes and this information about transactions and how well you can customize your tax audits approaches, for example. How can we make this information more valuable to tax authorities in order to change their audit processes? And regarding Cassandra, I found it super interesting because that's also the story of my own country. Sometimes we take the OECD approach and we don't know quite why we are doing it. And I was thinking a lot about the role of big fours and law firms in this. And I was wondering if you had any thoughts on the role of these people usually being trained in the US or in Europe, and how do you think that, if you have found something around that in your research, because at least in Latin America that's pretty common. You have big law partners, big four partners that are trained in the US or in Europe under the OECD approach. The same with tax authorities, they get back, that's what they know, that's what they feel more comfortable with, so they are more open to using the OECD approach. And also there is an active OECD influence in academia as well in so many ways. So I was wondering what were your thoughts on that? Anyway, I have so much more, but I want to give you a space to you guys. So I'm going to maybe run through some of the main questions aloud, and then I'll give you time so we don't run out. So there is a general question here for everyone, which is, what list of countries do you refer to as a tax haven list, blacklist? Maybe you don't give us the exact list, but the variables that you take into account more. That's a general question for everyone. And then there is this question mostly regarding corporate tax havens, which is the OECD sets the rules for international tax law, yet appear to make leeway for MNCs to abuse the tax system via havens. The multilateral instrument doesn't really help developing countries. In response, do you suggest developing countries set their own standards, responses on the work in their interest regarding corporate tax havens? Sandra, you should probably jump into this one as well. There's another question about the corporate tax index, which is, do you think there could be a benefit to also acknowledge particular subnational regions which might have more tax haven interest? Rachel, maybe you can take this. How are we thinking about going more micro and targeting regional places like Delaware they are mentioning, for example? There is, maybe we can start with that, because we only have 10 minutes left. So please, I'm sorry I extended myself, but please, can you, maybe we can start with Rachel, give it 2 minutes, and then we go through the panel.
Great, thanks, Fernando. So really thank you for everyone for the questions. And maybe to start with this, what is a tax haven question? So as a corporate tax haven index, we don't produce a binary list, and we don't have a threshold to label a country a tax haven or not, as you mentioned in your question, Kasim. Instead, we place a jurisdiction, corporate tax policies, on a continuum. So rather than a binary of a tax haven or not a tax haven that we see in these traditional so-called blacklists, the index tries to produce a more nuanced picture. So it takes into account that, in the words of Professor Sol Picciotto, that virtually any country might be a haven in relation to another. So to understand the risks for a country, we also need to take into account the flows between countries. So to put this in sort of like concrete terms. So for one country, say like Malawi, where I'm from, Ireland may be more problematic than the British Virgin Islands if there are more flows between Malawi and Ireland. So there's more exposure to corporate tax avoidance risk there. So having a tax haven list that just lists countries often without clearly objectively verifiable data points isn't that helpful when you come down to the national level. And there, I'm just going to put a plugin. We've developed an illicit financial flow tracker that maps financial flows against tax haven risks for countries. And so you might want to check that out, and hopefully that will be put on the message boards. And maybe before I sort of hand over to answer some of the other questions that were asked and that you brought up, Fernando. So the corporate tax haven index can actually be taken as a set of benchmarks, because we assess a country, as I was saying, on a continuum from like zero risks for promoting corporate tax abuse to being extremely complicit, so 100% opacity. And I maybe give a straightforward example. We look at public company accounts. And a best practice is when all company accounts are published online for free in an open data format. And so such a policy would be given a 0 haven score. But with increasing opacity or increasing corporate tax haven risks, if it's not online at all, or if it's online for a small fee, or it's online but it's not free. So we have different ways of gauging this, which maybe speaks to your question, Mary Louise, because and I think Cassandra's presentation actually spoke directly to your question, but you can use a corporate tax haven index to think through and look at what are the alternatives, what are countries doing to protect themselves, particularly in looking at indicators in the that focus on transparency and tax and anti-avoidance, which are have a lot of indicators that provide ways that a country could, at the domestic level, protect itself, to protect the tax revenues, with the examples I guess that Cassandra's already given, like with Rwanda. And yeah, I know that we're really running out of time. So the final question I think that was asked, that you just asked me, Fernando, was around like looking at the subnational level. And we do that. So when we're looking at what the lowest available corporate income tax rate is, we look at what are the specific carve-outs that are offered for a sub-region, so such as Delaware. But I think it would be really interesting to look at what would happen if you took the USA, took out Delaware and those other states that have very very corrosive policies, and compared it against those states in particular. So as an index, we tend to take the weakest link approach. So in a country, we take the weakest link. And I know there was a couple more questions. I'm sorry. I guess I want to hand over to my fellow speakers. So thanks so much.
Thank you, Rachel. Margarita and Baptiste, maybe Baptiste, you can start.
Yeah, definitely. So yeah, first of all, thanks for the questions and comments. And so first of all, yeah, for the question about the list of tax havens. So yeah, actually, I mean, there are many classifications. So what I do for my part is that actually I use the one of Darren and Lindsay as a baseline, but actually in the paper, I mean, I changed the classification. I look, for example, of the classification of Heinz and Heiss of the paper in 1994. I cross the two lists. I can take like the union of the two lists, the intersection of the two lists. I can also get rid of some very big tax havens. You can think of Switzerland, you can think of Hong Kong, Ireland, all these countries, that are relatively big and relatively well connected to the rest of the world. And the reason for that is that actually, I mean, FDI in this country is actually maybe totally unrelated to tax avoidance. But I mean, if you are referring, I mean, in the literature, we know that firms tend to do FDI in some countries if they are relatively big enough. Okay, so yeah, I get just rid of these very big tax havens because I think it's fair to assume that FDIs in very, very small and remote countries and jurisdictions are actually fall within the scope of profit shifting. But anyway, yeah, the results seem to hold whatever the classification of tax havens. And second, just to come back on the data thing that you were mentioning, Fernando, it's true that it's very hard to get data, very precise data, in order to investigate such issues. You need to have firm level data, you need to have some data about the ownership structure of the firms. And this is definitely something I struggled with, actually. But yeah, so what I do in the paper is that actually, I use CompuStat data, which are relatively relatively used in the corporate tax avoidance literature. But still, I think it's not enough. So for example, I have some data on employment, but employment is at the aggregate level. Also at the worldwide level, I have no information about the employment of each firm in each country. So I know the number of establishments, I know the number of subsidiaries, but I have no idea about like the precise number of employees in each of these subsidiaries. And this is definitely a limitation. So of course, I try, to clean for some polluting effect, but it cannot be perfect given the data, actually. So yeah, I think that in the future, it could be very, very good to have an easier access to very disaggregated data in order to investigate these issues about the effect of profit shifting on inequalities, but also more globally to investigate profit shifting. I think that this is something we can all agree on.
Thank you, Margarita. Do you want to jump in? Just a minute, please.
Okay, thank you, Fernando. Well, I'm sorry, I don't think that I will be able to properly answer your question about regulation in France. Maybe Baptiste, I think that Baptiste is French. Maybe he knows a little bit more about it.
Yeah.
But what's for sure, you were talking about rent sharing. I'll give you the floor in a second, Baptiste. But maybe about rent sharing, which is, you were saying that in Peru, I think, is that employees have the right some percentage of a firm's profits. I don't know what's the legislation in France. I don't think that would be the case, but I prefer Baptiste if he knows that to answer that. However, what's for sure in France is that mass layoffs can be very expensive. There is a relatively strong social protection in France. So I refer you to the paper. I give two or three examples, which are nicely documented by a professional lawyer defending former employees of multinationals who do social fraud. In order to avoid paying severance payments, which can be very, very expensive in France, they what they do is that they multiply the number of affiliates. So again, since I was talking with lawyers, what they told me is that we have to be careful because it is technically not necessary to have an affiliate in a tax haven in order to do the social fraud. What is the social fraud? Is to transfer this severance payments when you have mass layoffs to the taxpayers. Something that is called in France assurance garantie des salaires, which is just a mechanism which is paid, of course, by the taxpayers to ensure all salaries and the sums due to employees when you have an insolvency. So what I argue is that since you have a financial lack of financial transparency in tax havens, this can be used in order to show that you are insolvent, or in order to. But again, I try to be careful with this because the only thing that I find is that when I go to a tax haven, well, not me, but when the firm goes into a tax haven, its employees sharply decline. So, which is something that I was not expecting. I was rather expecting this effect on the rent sharing, precisely on the wages, which is what Baptiste defines.
I am so sorry. I have to cut it off at this point. I'm so sorry, Cassandra and Swati, but they are killing me from the back door. Thank you so much, everyone, for sharing your research with us. It was amazing hearing from you. And please, everyone seeing us at home, keep in the Zoom, keep in the Tax Justice Network conference. We will immediately start with the next session, which is The Devil is in the Detail and in the Shadows, illustrations to understand gender impact of private sector interest and policy reform that can counter. So we'll leave you with that. Thank you so much, everyone, again, and hope to discuss again with you soon.